Hi, in today's video we will review a simple P2P process and analyze the GL impact at each transaction. We'll begin with some basic accounting stuff and then move on to each transactions. In accounting, every transaction involves both a debit and a credit recorded in the general ledger, and this is called double entry accounting. So many of you have heard of the famous accounting equations where assets equal to liability and equity. So we'll explore the accounting equations and financial statements in another video, but the only thing you need to remember for now is this table. So always remember this little table, take a screenshot and store it somewhere. Next, let's take a look at a simple P2P flow, which is creating the PO for your vendor, receiving the items into your inventory, generating your vendor bill, and paying your vendor. So in future videos, we'll cover topics such as vendor prepayment, in-transit payments, and so on, but for today, we'll keep it very simple. So, purchase orders, no GL impact, so we'll proceed directly to an item receipt. So when we receive items, we impact two accounts. The first one is your inventory, since you're receiving items into your warehouse. Inventory is considered to be an asset located on your balance sheet. Think of all the things you own as assets. Now, if we look at the little table, an increase in your assets, in this case more inventory, correspond to a debit. That's why when we view the GL impact of an item received, it's always debit of the inventory or asset account. Again, thinking in terms of double entry accounting, the next account which is impacted is your accrued purchases account, also known as inventory received but not yet paid. This account is considered to be a liability on your balance sheet because they are obligations that needs to be settled in the future. If we look at our little table, an increase in liability, in this case obligation to settle, results in a credit. Next transaction, vendor bill. So the first account that is impacted is your accrued purchases, which we went through in the previous slide. So when creating your vendor bill, you're recognizing the increase in its obligation. So in this case, you are decreasing your liability, thus resulting in a debit. On the other hand, you're recording the money that you owe to your suppliers in your accounts payable. And your AP account is a liability, thus an increase in your AP account results in a credit. Finally, you decide to pay the vendor. So the two accounts that are impacted are your accounts payable and bank. There is a decrease in your AP account because you're settling your balances with your supplier. And since AP is considered to be a liability, a decrease in AP is a debit. On the other hand, we are paying our vendors using a bank or cash account, and these are considered to be assets that you own. Therefore, a decrease in your asset results in a credit. If we summarize the whole P2P process, so PO, as we said, no GL impact. Upon receiving your item, you increase your inventory, that is your asset, and increase your accrued purchases, which is a liability, thus a credit. When generating your vendor bill, you kind of cancelled out the accrued purchases account and credit your accounts payable. Finally, when paying your vendors, you decrease your bank balance and decrease your AP as well. So in the end, you cancel whatever is in your accrued purchases and accounts payable account, and what's left is basically you bought some items into your inventory and you paid your vendors for those items. Thank you for watching. Bye bye.